And we're back on this absolutely terrible day. I really hope there's not too many people that are suffering from this whole Luna debacle. Really, US terror bull, that's what it is. And that's what it should also be known as. It's built on a Ponzi mechanic. It's built on a snowball mechanic in the background. And well, let's quickly explain why the standard is different, but also what happened.
Yeah. So first of all, Luna is the token that was backing UST, the stablecoin called UST. What happened is the whole protocol lost, like investors in that protocol, people that were actually holding the stablecoin as well as Luna, they lost the confidence that the peg will hold in this crypto winter. Because basically, when the crypto winter kicked in, this bear market kicked in which we are currently, the Luna price started to drop like the price of many other cryptocurrencies. And through that mechanic, people thought, wait, if the asset that is backing the stablecoin is dropping in value, how will the peg hold up? So people start selling off UST. And then when UST started to drop in price, it had a ripple effect on Luna again. So then the sister coin Luna of UST started to drop in price again. And so it was a ripple effect back and forth, vice versa, that led to the point that UST completely decoupled from its peg, from its US dollar peg, and went down trading towards 15 cents where we're currently. And Luna basically went from $80 a couple of weeks ago to almost nothing. This is one of the most horrible crashes in cryptocurrency. And at that point, I want to say really sorry to those people who trusted that protocol and who invested a lot of money into this. But now, Josh, why is the standard different?
Yeah, look, it's one of those things. You cannot back a stable cryptocurrency with fluff, with air, with steam, with something that you can print out of nowhere. Like, this is the whole point we're in this game, is to get away from the Federal Reserve System that can print money out of nowhere and say it's valuable. Value comes from real things, from real term, from real work, and you're storing that value in this thing, on this piece of paper, in the gold. Gold has sort of this inherent value. So what the standard hopes to do, and the standard comes from the saying the gold standard, right? The gold standard, the Bitcoin standard, the standard. By taking a real asset, rare asset like Bitcoin is a rare asset. We can't just create more Bitcoin, or even Ethereum. We can't create more Ethereum out of thin air. But the best part is that the standard also focuses on gold bullion, physical gold bullion. We cannot just mine more gold bullion out of the ground like this. It takes a lot of work and energy and power. So by allowing a decentralized version of tokenized gold plus the ability for people to collateralize smart contracts with Bitcoin and Ethereum, we're putting real value behind it. And then from that real value, you can print just a fraction of that value as standard euro, standard yen, standard US dollar, and some of the other stable coins that we'll be releasing. So there'll always be less stable coins out there than real collateral backing it. And this is the core difference. But there's also other differences. If the value does go down, like if Bitcoin starts tanking, before it liquidates, you can set it to say, hey, trade this to gold, something less volatile, so that it doesn't get liquidated. Or if it's heading towards liquidation, people will be notified and they can go and buy the stablecoin off the market, burn it, and get their collateral out. The fact of the matter is, any stablecoin solution that is serious needs to have real value backing it. This whole notion of algorithmic stablecoins is failed. It's failed and failed and failed over and over again, and it's not going to work. You need to have real value backing it.
Right. So now it's time to say goodbye and hope to see you guys soon again on our channels. Hit the like button, hit the subscribe button, and see you soon.